Okay, good to see everybody again. Now, what I try to do when we do these webinars is I try to split them up. We'll do one is a very lesson-based webinar. Then the next one will be kind of a market timely sort of trading and analysis type session, looking at showing you how I would set up some trades and things like that. Okay. And so today is one of those education webinars where we're really going to focus in on a market event that I think can really help you if you understand it the right way. Okay? Now, let me just back up a little bit. I'm not going to tell you my whole history at all, but there is a part of it that is very important as it relates to today's topic, which is gaps. Many different types of gaps. We're going to talk about focusing on really two of those types of gaps today. Why are gaps so important? Well, a gap is really the ultimate picture of a supply and demand imbalance. Remember, at the opening of a market, opening of a market, occasionally around big news events or numbers, markets gap. Why do they gap? They gap because at the current price level, supply and demand is so out of balance that you don't even get any trades at that level. Price has to gap away from that level just to find a buyer or a seller. Okay? So it's very, very important that you understand how powerful gaps are. More important to understand why a market gaps in the first place. Okay? So make no mistake about it, gaps are the picture of the ultimate supply and demand imbalance. Okay, is everybody pretty clear on that? All right. Now, there are different types of gaps. Okay. Today we're going to focus on, the two that we're going to focus on are what many would call the professional gap and the novice gap. Okay, remember in trading, make absolutely no mistake about it. Trading is very simple. It's the people, how the trading works, I should say, is very simple. It's the people that know what they're doing getting paid from the people that don't. The novices paying the professionals over and over and over and over. Okay, that's how markets work. Okay, so it's our job to be on that professional side and identify when the novice trader is entering the market and simply be there to take the other side of that trade when we have a low risk, high reward, and high probability entry. Okay? So let's start to define what a novice gap and professional gap look like, right? Well, I think we'll touch on other gaps today, but let's focus on these two right now. For the novice gap, okay, that's the really important one. For the novice gap is a gap after a move in price in the direction of that move. Okay? I'll say it again. A novice gap is a gap after a move in price in the direction of that move. Okay? Why is that called a novice gap? Because only a novice trader would be buying after a rally in price, okay, and after a gap up in price, right? Only a novice trader would be buying a gap up in price after a rally in price. Okay. Now that in and of itself is novice enough. That's bad enough. But now, when you have someone buying on a gap up in price after a rally in price, like you see here on the chart, now you bring support and resistance into it. Now you're really stacking the odds in your favor because you're identifying someone that's taking probably the lowest high probability trade. So you want to be there to take the other side of that trade. Okay. I don't know if you can see my pointer on the screen, but here we have a rally in price from around 88.50 all the way up to 89.50, and then we have a gap up in price and into resistance. Okay? So again, we have our picture of a novice gap here. There's a gap up in price after a rally in price. Somebody who is buying here is making a big mistake. Okay? Couple that with the fact that they're buying into one of our resistance or supply zones as defined by a rally, base, and a nice strong drop, we want to be there to potentially be a seller to that buyer. Is everybody pretty clear on that? This is something we go over in the extended learning track here at Online Trading Academy. Okay, no questions? Now remember, taking a short position up in that line, it's easier than it looks, okay? And for those who haven't seen this before, when we do our support resistance levels, it's very important. We are creating a supply zone. Anytime you hear me use the words demand or supply, I'm simply interchanging those for the words support and resistance, okay? And we're putting two lines around this area here. The reason we're doing that is to create a zone of supply. The bottom line and the top line create that supply zone. Why is there supply there? Well, we have our pattern, rally, base, and drop. Okay? Not the drop, base, and drop, but the rally, base, and drop. All right? Once we find that, we wrap a couple lines around that and extend them forward. Okay? If and when price comes back to that level, we say that price is revisiting the supply level. Somebody's buying after a rally in price into an area where supply exceeds demand. They're probably not making a wise decision doing that. So we want to be there to potentially take the other side of that trade. Okay? If it's a gap up in price after a rally in price, now that's a fairly novice move. Reason why we use those two lines instead of one line, if you read in the books or take a lot of courses, you'll see that just about everybody uses one line as support and one line as resistance. I try to always make sure that I'm talking about real world trading. Okay? Using one line as support and one line as resistance is a little unrealistic. Okay? To think that you're going to just pick the exact point to buy and the exact point to sell consistently for a trading career is very unrealistic. So instead we create a zone, wrap some rules around it, and give ourselves a good chance in the trade. Okay? Any questions? Okay, that is the novice gap. Obviously, in Forex, the time that we're going to find the novice gap most often, or a gap period, is on that Sunday open. Let me see. In this chart, I think I found some professional gaps as well. Well, just here's another example of a novice gap. And instead of being a shorting opportunity here, this would be a buying opportunity. I haven't drawn in the support and resistance, but understand here's just the opposite of the one we just saw. This is another novice gap. Why is it a novice gap? Because it's a gap down in price after a decline in price. Okay? So again, who's selling there? The person that's selling there is selling on a gap down after what is already a very big move down in price. The professional, consistently profitable trader wouldn't do that. The laws of supply and demand guarantee that you're going to lose over time if you take that novice action. So we want to identify the novice gap and then quickly identify where the nearest area of support or resistance is, demand or supply. That's really the process. Okay? And then you could see shortly after that novice gap down, prices rally. They're not always going to gap right into support or demand, or resistance or supply, but that's why you want to identify where that level is. It's usually very close to the gap. Okay? All right. Yeah, John, obviously the Forex market's gap once a week, but I can tell you that in the trading room that I do, we have a Sunday session so that we can catch that gap, and usually those are some of the best trades of the week. Okay? Those are the ones you really want to look for. Okay? And most of the time, those are some pretty big moves. All right? And that's really what you want to do in the Forex market, take advantage of the big moves that the Forex market offers you. Yeah, yesterday, there's some good examples from yesterday. Okay, we just looked at one of them. All right. Yeah. So, John, yeah, this is the Forex market more often than not. Well, you're looking at that Sunday gap. Which again, if you hang around Forex traders, you'll see that that Sunday open usually provides, if they know how to play it right, the majority of their income for the week. Boyke, yeah, gaps almost always close shortly after they're created. It's rare that a gap doesn't close shortly after it's created. And one of the reasons why, the main reason why they close so quickly is because think of why prices gapped from where they gapped. Think of why they gapped at the origin of that gap. Why did they gap from the price level that they gapped from? It's because there's a lot of probably professional money sitting at the origin of that gap that wants to get filled. Okay. Remember, I come from the floor of the Chicago Mercantile Exchange, and I was in that game for many years. Okay. Those gaps are key. When you have a gap, you have a serious imbalance of order flow, right? And because the Forex markets move and trend so much, the trades that you can catch on that Sunday open are sometimes incredible. Okay. In fact, I would say, just from my experience, every Sunday, if you look hard enough, and you don't have to look at more than, I'd say, a handful of markets or so to find a really nice opportunity. Sure, I'm sure those will get filled. Usually they get filled fairly quickly, but we'll look at some of those. But for right now, it's important that you understand what the what the professional gap and novice gaps looks like. Then you incorporate support resistance, and now you've got a pretty robust. Yeah, I see the question there about supply and demand. Sometimes go higher and lower than the level. How do we determine that this level is sustained? Fake entries? Yeah, I mean, that's obviously a function of how quality the supply and demand levels are. You're going to find levels all over your chart. You want to find the ones that, if you want to make them kind of higher probability, make sure that more are working out for you than not. That a lot of that is going to be a function of your profit margin. Okay. If you're finding levels as defined by your rally-based drop and drop-based rally for supply and demand, then if you're finding that maybe those levels aren't holding up that well, just simply find ones with bigger profit margins. Find supply and demand levels, resistance and support levels that are farther apart from each other. The farther apart your levels are, the higher probability those levels are going to be, your trades are going to be. All right, so here's another example of a novice gap. Okay, remember, anytime you see a strong move in price and then a gap in the direction of that move, okay, a gap up in price after a rally in price, that's a novice gap. Okay, simply look to the left, figure out where your nearest supply level is, and not a bad idea to get ready to look for a short position. Okay, the last thing we want to do on that trade is buy, right? And again, just one more time, the opposite of that would be the novice gap down, which is a gap down in price after a decline in price. Okay, that would be a novice gap. You're just going to transfer your account into somebody else's, right? You don't want to do that. So let's start that part over. Talking about a professional gap. Okay, that's a gap in price after a move in the opposite direction of that move. So over here on the chart, we have a decline in price and then a gap up. Okay, the novice gap would be a decline in price and then a gap down. Here we have a decline in price and then a gap up. That's typically a professional gap. Okay, the low risk, high reward action to take there is to join that gap, whereas in the novice gap, we want to fade that gap. Or look to fade that gap, when the risk is low and the reward is high. So in the professional gap, we want to join that gap. How do we do it? Well, once you see that there's a gap up, once you've determined that it's a professional gap, simply look to take the first pullback. Okay? All right? Simply look to buy the first pullback in price to that gap. This one looks like it didn't come back right away. Usually they will. That yen we just saw a few minutes ago did. This one, here's the yen, I'm sorry. So here's another professional gap up here. Rally in price and then a gap down all the way down to here. Here's the close, here's the open. Okay? Again, this is yesterday evening's gap. All right? The proper action to take there, usually you'll get a quick rally in price up to the origin of that gap. Why is the origin important? It's because that's where the big supply and demand imbalance is. That's where the order flow is really out of balance. Okay? So on a gap up, on a professional gap, the low risk, high reward, high probability action is to wait for a move to fill the gap, right, back to the origin of that gap, and then you look to join that gap. Okay? All right? Any questions on that? The difference between the definitions? The difference between professional gap and novice gap? Oh yeah, we'll be able to take a look at the pound. Yeah. Yeah, like I said, most of the time, and if you look back at your chart, you'll see most of the time, gap does get filled fairly quickly, but not always. Okay. Now, yeah, let's talk about. I see FX007 really wants to look at that pound, so let's do that. Now, when a gap doesn't get filled right away, what does it tell you about that level? Small imbalance of buyers to sellers or a big imbalance of buyers to sellers? If the gap's not filled, yeah. Okay. MLC, I don't think I've ever seen a gap that didn't fill. Okay, I'm not saying there aren't any. I've just never seen one. So here we've got the pound. Okay. Gap down into a drop base rally. Looks like the low of this demand level's all the way down here. So it's a pretty wide level. I don't know that you'd want to take that level as a demand level to trade off of just because it's so wide, but you could. And I wouldn't be surprised at all if this gap got filled in the next few hours or so. Okay? Now remember, there are more than just these two types of gaps. Why are we focusing on learning these two types of gaps today? Because these are high probability events when you play them right. Okay? And this gap here, would I call this a professional or novice gap? You probably have to call this somewhat of a novice gap. Okay? Drop in price, then a gap. All right? You probably wouldn't throw it into either side that strong. Okay? Not every gap is a pro or novice gap. All right? But we're focusing on those two today so that you can have those to think about and trade off of. Let me get caught up here with the chat just a second. So the question here is if there's a gap open in the direction of the recent direction, so our intention would be to take a trade in the opposite direction. Yeah, what you've defined there is really a novice gap, okay? And the more novice it is, obviously, the better the trade is likely to be in the opposite direction. The stronger the demand that it's gapping into, or the stronger the supply it's gapping into, that's another factor that would just really help that trade. Okay? Okay. And the way that we enter positions is not something we were going to spend a lot of time on today, but I'll go over it here. Okay. John, yeah, you don't have many people at all trading these Forex markets prior to that open. Okay, and right, you don't have many players at all trading that. But when we say join the gap, that means we're saying if it's a gap down, be a seller. If it's a gap up, be a buyer. If we're saying fade the gap, that means if it's a gap down, we look to be a buyer, and if it's a gap up, we look to be a seller. Okay. So yeah, an example like this with this pound here. Let me see here. Let me just move this to maybe a smaller time frame. Maybe we can. We've got in the XLT. Most people would probably take these wicks. Okay, if anyone here is in the XLT, we would take the extremes of this area, the drop, base, and then the rally. All right, most people in the XLT would take these extremes. Remember, in the XLT program, we spend, which is the trading room I do, we spend a lot of time learning how to draw these lines and all that stuff. Very specific lessons, but yeah. So, drop in price, big gap down. You'd wait for prices to probably dip in your demand zone. If you want to know exactly how we traded in there, there's two ways. If we feel very strongly about the trade, and in the trading room, we come up with a probability score looking at a few different things, nothing complicated. But if we really like the trade, if it scores out to a high probability trade, we buy at the top black line with our stop just below the bottom. Okay, that's usually a limit order. Buying here with a stop below the bottom of the demand zone. If it's a trade that's okay, but maybe not that great, we would use our other type of entry, which is a confirmation entry. In other words, we let prices dip into the level, and then we look to buy as they leave the level. If and when you get filled, your stop is still below the area. Okay? And why do we call that a confirmation entry? Because if prices come down and end up just going through the level, maybe you didn't pick a good level, or maybe it's just not a high probability level. If they come down and end up going through the level, there's no trade and you don't get hurt. So it's a pretty safe type of entry. Okay? So I know a couple people are looking for exactly how would you enter a position like this. And then one of your targets could always be the origin of the gap. Because again, that's where the big imbalance of buyers to sellers is. And we actually had a session yesterday evening looking for these opportunities. All right, so let's move on here because I want to make sure you kind of get all this. These are tools, you can, my hope today was that after 45 minutes to an hour, you'd have another set of really high probability tools in your kind of trading toolkit there that you can use or at least consider. All right. And, at the very least, too, I mean, my goal is always to make sure, it's not the profits first and foremost. If I'm talking to people that are kind of new to trading and trying to make it, the goal is always to hopefully make sure that you have enough understanding of how markets really work so that you're not just, you're not caught on the wrong side of the market consistently, okay? Because those people that are caught on the wrong side of the market that take that novice action all the time, they're really just handing their account over to someone who knows what they're doing. Okay? All right. So again here, now this gap that I've circled up here, is that a professional gap or novice gap? Let's see how well we're kind of understanding this and owning the knowledge. Some people saying professional, some people saying novice gap. Yep. Looks like the majority is saying novice gap. There are some people saying professional gap, so it's important that we understand this. Okay? Yeah, it's a novice gap because we have a rally in price because it's the reason why it's a novice gap because it's a gap up in price And once you see the gap up, simply look at the price action that precedes the gap. Here it's a rally in price. So again, right, rally in price, then a gap up. We then look for supply. All right. And remember, the focus today is not exactly our supply and demand levels. That does help make all this work. But the focus today is really to identify those gaps, because that Sunday afternoon, evening trade, wherever you are in the world, is usually, usually offers you some of the most powerful opportunities of the week. Low risk, high reward, high probability. So gaps up right into an area where when price was there prior, the chart was telling us there were a lot of sellers there. And what told us that? Well, prices were trading here for a short period of time, but they couldn't stay there. They dropped away in strong fashion. That suggests that there's a lot of supply here. That's the only thing that could cause the drop in price. If that statement wasn't true, prices never would have left this area. They would have just kept trading sideways here the whole time. So the people that were buying on this gap up, there was probably some good news on this yen market, right? Good news on the yen, bad news on the dollar, whatever it was. People probably looked at that news or heard that news and jumped in the market based on that news. They're also buying in the context of an uptrend. So they don't know that they're doing anything wrong, okay? But the problem is they don't understand how markets really work, okay? Absolutely, Exanti. This concept is, all we're talking about here is people, our people. People and their emotional-based decisions. So whatever market we focus on is almost irrelevant, okay? And the beauty of doing this in the Forex markets is that these markets move probably more than any other markets in the world, okay? So on this chart, we're bringing in the Bollinger Bands, all right? For those that really like to use indicators and oscillators, that's fine, okay? We don't want to use them as is. We don't want to use them just like the textbooks tell you. Instead, wrap that professional and novice logic around these indicators and oscillators, and now they can really help us. So we could see here. Again, let's just start fresh and add the Bollinger Band. We've got a rally in price, then a gap up. That's novice in and of itself. But that novice gap also brings price right up into a supply zone, while you're also piercing the upper Bollinger Band. Can you see how we're just really stacking the odds in our favor by finding a group of buyers that are making a really big mistake based on the laws of supply and demand? Okay? John, I wouldn't say all brokers, don't like scalping. The big players, I don't know that I never saw big institutions scalping. Big institutions, banks, or really anybody that is consistently very profitable, they're putting on big positions in the right place and holding on to those positions. Okay? And let's use this example, John, as an example. And this is something, again, I facilitated that big order flow for years, and here's exactly how that happens. When prices are coming rallying here, right, what do you think the news is? You think it's good news or bad news? You think this is big news or good news or bad news during this rally? It's probably good news, right? Yeah. Okay. So that's going to invite, people into the market that listen to the news. Then you've got an uptrend in price, which is going to invite more buyers in. Okay. And whatever happens on this gap, some positive event brought in too many buyers. Too many more buyers than sellers were present on this open than there was enough available supply at the prior candle's close. That's why you have a gap. So when prices gap up here, you have all this retail buying coming into the market, or this retail mindset this novice mindset coming in and buying this market. But let me tell you, from my experience on a trading floor, handling and facilitating institutional order flow, for every probably 100 or 200 individual buyers up here, there's usually one order on the other side of all those trades. Okay? Does everybody understand that? Anytime we'd reach a good level, so much retail would come in on the wrong side, just filling a giant order on the other side. Okay? And that giant order was just sucking in all those retail accounts. Okay? Does everybody understand that? I mean, that's how markets work. Okay? All right. So again, if you're adding indicators or oscillators, try to do it the same way we're suggesting here, which is wrapping some logical rules and thoughts around your indicators and oscillators. Okay. There was another question there about how long do we keep our demand and supply lines on our chart? That's an excellent question. In the trading room, we have a very specific rule for that. Okay. Typically, we want to be there to take that first pullback in price into the level. Okay. So if we consider this the first pullback in price to this supply level, a lot of people in the trading room would not short again if price came back up into that level. The reason is because with each successive rally into this supply zone, the number of sellers is being reduced, so the level is losing its power. The number of sellers is being reduced because every time price gets there, more of the sellers that make up that supply are able to sell. Okay? So typically, the high probability trade is taking that first pullback in price. So ultimately, it's going to be up to you how many times you're okay taking a trade at that level. But as long as you understand that each time prices hit that level, the level's getting weaker, you're probably going to lean towards only taking that first, second, third pullback. All right? The more objective way of looking at it is instead of focusing on touch count, how many times prices are coming into the area, you might want to focus on the level of penetration into an area. That's a more objective way of doing it. In other words, if prices just touch the level and turn the first time, right? If prices just touch the level and turn the first time, there's probably a lot of sellers there. Okay, so you could probably take another pullback into that area, right? But once prices go fairly deep into that level in the trading room, we have a rule of 50% or deeper. That pretty much tells us that your supply and demand is really probably gone. So be careful. Boyke, most of trading I think is a zero-sum game. But I can tell you the one thing that I learned on a trading floor more than anything else is that this whole thing is just this whole trading game. It's just how it works is very, very simple. I'm not saying doing it is simple, but how it works is very simple. It's the people that don't know what they're doing just paying the people that do. These accounts just get transferred very quickly into the accounts of the people that know what they're doing. Okay? If you're trading with a broker who can see all the order flow, who has all the orders, and they're on the other side of your trade, I mean, just do the math. All right? And I would say that again, all this logic and stuff is very simple, but actually doing it is another story. It's because the market has such a fine way, such a strong, powerful way of sucking people in the market on the wrong side, right? The better the news is, the more green candles you have on your chart, the higher price goes, the more people are naturally invited to buy. Okay? That action really goes against how you make money buying and selling anything, right? Well, understanding when to enter, you really want to. That's why you have to make it rule based. And even with all that, is every trade going to work? No, every trade's not going to work. But that's why we keep it low risk. We keep it low risk by, by keeping our entry point, close to our, our stopping point, our stop loss, and then adjusting the position size to make sure that we're not risking more than we're willing to risk. Okay. And so that is the end there. Thought there was. Here's that pound that everybody wanted to look at. So yeah, gaps usually fill very quickly. Gaps usually fill the same day they're created. It's very rare that you'll find a gap that's not filled the same day it's created, right? And before we end the session today, I just want to make sure that everybody really understands the concept. Remember, today was an education session, not necessarily a trading and analysis session, meant to give you some simple tools and rules that would help you, hopefully help shift the odds a little bit more in your favor. Does everybody understand the difference between a professional gap and a novice gap? A novice gap being a gap in price after a move in price in the direction of that move. A professional gap being a gap in price after a move in price in the opposite direction of that move. Okay? There are other types of gaps. We haven't even mentioned the word trend today. You could certainly bring the trend into what we're talking about. What we added with the professional gap and novice gap is support and resistance, demand and supply. That's key, right? Your demand and supply levels are some of your primary decision-making tools. If you add the trend into this, now you can really stack the odds in your favor. For example, if we have a gap down in price after a drop in price, that's a novice gap. If it's into a demand level, okay, and in the context of an uptrend, now that's a trade you probably want to take every time you see it, on the long side, that is. You see what I'm saying? Okay. To define the trend, there are a number of ways you can do it. Bollinger Bands are okay, but you could also just put a kind of a slower moving average on your chart and just glance at it. You can look at the price action, lower highs, lower lows, higher lows. Remember that just identifying what the trend is not that doesn't do anything for your timing, and you don't need it to, so it's not a big deal. Okay, for timing we use our levels. Yeah, 50 is fine. Okay, 50 is fine. So hopefully this helped you a little bit. And if you have any questions, let me type my email address in here. And we'll be back again doing another one of these events where, and the next time we'll instead of it being lesson based, we'll focus on scanning the markets, looking for trading opportunities. Okay. Here is my email address if you need it. So there it is, sseiden@tradingacademy.com. And thanks for your time. We'll talk soon. There's my email address. If you have any questions or comments, feel free to send an email. And if you do, try to remember to put FX Street in the subject line. That way I'll know exactly what we're talking about and all that. So, all right. Well, thanks, and have a great day, everybody.